But I'll start off like I usually do with just a little summary of what I saw in the stock market this week. Was again another interesting week, like we have been having quite often recently. Started off the week really well. Market continued up its uptrend that started, last week until we hit yesterday, where Meta Platforms, which is formerly known as Facebook, had a really bad report. They had some of their subscribers, drop, which is the first time that's happened in I think in their history, but certainly in a long time. They talked about the Apple privacy concerns, creating, $10 billion less in revenue. They lost $10 billion on their, metaverse investment so far. Investment into that's going to take a while, and their guidance was a little bit more poor even than their actual results. And so we ended up yesterday with the largest single dollar loss for any stock in history. $232 billion disappeared from Facebook shareholders, which is kind of incredible. But I thought what's more incredible, though, is that it kind of went through a lot of different companies. I mean, semiconductors were coming down and all these different areas. Didn't make a lot of sense to me, because when you look at their report altogether, what you would be looking at right there is company specific issues. When I look at these company earnings, I'm really, really trying to figure out what's causing their, rise or fall, and especially in relationship to the economy. So is the economy doing better, or is the economy doing worse? And the reason is because if you look at the stats, it's very important. We get lots of these small downturns. The average downturn without a recession is negative 15%. So that's kind of normal. They definitely happen. The average downturn, if you have a recession at the same time, is negative 36%. And the recovery times are dramatically different as far as that goes. So really not that wildly concerned about the 15% downturn, but definitely want to know about the 36% downturn with the longer recovery time. So when I look at what happened with Meta Platforms yesterday, I'm looking at that thinking, is this an economic event? Is this something that the economy is causing this problem? In my opinion, it's definitely not. This is a company specific event. So that's kind of interesting as far as that goes. And then this morning we had a jobs report that came out. We ended up with 467,000 jobs created in January. The expectation was for 125,000 jobs. So on the face of it, normally that's considered a good thing. More jobs, right? And we even have more pay, because pay has been coming up. But when you talk about the stock market, traditionally in an environment like this, when you have a lot more jobs than expected, it scares the stock market, because we're in a situation where the Federal Reserve is starting to tighten up money supply. And if you have a lot more jobs than expected, that can mean that the economy is growing even faster than expected. And that allows the Federal Reserve to get even more aggressive. And when they get more aggressive, they can slow down the economy even faster. And that can ultimately affect earnings, which ultimately affects the stock market. So a lot of times you will see these job reports like this in an environment like this, where we're already kind of at a full, economic growth situation, be a negative. And we did see that this morning. We saw some drop off, early in the morning when the report came out. But I have another look on this, and maybe the market does now too, because the S&P 500, as we sit here, is up, about 1% or so. And so, because one of the things that's happening now, this is not the standard situation where more jobs equals, faster, a more aggressive Federal Reserve, because what the Federal Reserve is really looking at here is inflation, right? It's a dual mandate: full employment, they feel like they're there, and then fight inflation. And that's what they're working on now. But even the Federal Reserve has said very clearly that there's two parts of fighting inflation. Number one is to try to slow down demand, which they have some control over by raising rates. And the other part is to try to increase supply. And that's one of the other big issues we're having right now, right? We have these supply chain constraints. And so one of the problems with the supply is employees, having enough people to do what needs to be done. So I'll give you an analogy. Let's say you have a restaurant. You have a line out the door of people, trying to get into your restaurant, but you can't do a full 100% of your tables in that restaurant, because you can't get chefs and waiters and things like that, and waitresses. So you'll only do 75% of your tables. And so there's a supply constraint there, and the line stays out there and such because there's a demand. And what happens then is, as a restaurant owner, maybe you end up having to pay more for your, employees, but you are able to pass that along as higher prices to that high demand that's sitting outside the door. Well, then, if all of a sudden a lot more people come out and start taking the jobs, and now you can do all of your tables, maybe the line outside starts to shrink down. The demand is met essentially by having more tables because you have more waiters, waitresses, and chefs and what have you. So I think a part of this is different because this is a pandemic and we've had troubles getting people out into the workforce. So if you see 467,000 jobs created in January in the middle of the Omicron spike when we only expected 125,000 jobs, I think that has a positive. I think that starts to help the other side of the inflation story, which is really the supply chain side of the story. And I gave you a restaurant analogy. You can apply that to a lot of different types of businesses. And that's been my premise from the get-go, again, is that the first half of this year will be, trying to help that supply chain side. My hope is that it's better, at least somewhat so, for the second half of the year. That can help inflation, allow the Federal Reserve to be more flexible. Stock market would love that, more flexible language, at least coming from the Federal Reserve, because right now they're talking, quite strictly. So that's what's going on. I still think the basics are here. Economic growth is happening. Earnings are fantastic altogether, ignoring Metastock and a few others. Google reported this week fantastic numbers. Advanced Micro Devices just blew it out of the water and had a huge run up after their earnings announcement. Amazon came in last night with really good numbers. The economy is doing fantastic. These companies are making profits. They're exceeding expectations, and their the earnings growth is higher than expected by far. So the market's going to continue to adjust that. And again, it's very difficult for me to imagine a recession happening here in the short term, especially in an environment where we have this type of growth in the earnings. And if we don't have a recession combined with the stock market downturn, we're looking at more of the 15% variety instead of the negative 36% variety. And so, this little downturn we had could be over, could be recovering and coming back. It looks like it. I try not to get too excited about things because you never know what's going to happen. But definitely that one Monday, not this week, but the prior one, the 24th of January, where we had that huge reversal. So far, that's actually played out as a low point. So we'll see how that goes. But always interesting. It's interesting to know kind of how the stock market looks at something. It might be different than the way you look at things. And so that's important to kind of understand as part of the educational concept of being able to become a good investor. I think that's important too. So look forward to seeing what's going to happen next week, and we'll talk to you then.